Thanks. Good morning or afternoon, depending on where you are. Thanks for joining us. Apologies that my camera's not working. I even shaved today, but it's always. I swear it was working when I signed in, and it suddenly died on me. But anyway, welcome everyone. I guess we have a mix of people who are existing shareholders and people who are maybe new to the Brookside story. So for those of you who haven't heard some of this before, please bear with me. So we are Brookside Energy. We are a Australian listed oil and gas company focused in the US in the Anadarko Basin in Oklahoma. We are a ticker BRK and ASX, and we also trade on the OTC pink sheets in the US under the ticker RDF-EF. This quick disclaimer slide, let people read that at their leisure. So let's get into sort of the macro. As people are no doubt aware, especially those of us who drive cars, oil prices have gone up considerably in the last sort of year, particularly in the last 6 months, as of natural gas prices. And what we're seeing right now is I suppose we're at decade highs for oil and gas pricing. For several reasons. One, there's been considerable underinvestment in the last 10 years. I suppose there have been a shift to other energy sources, maybe a bit prematurely, and then there was COVID, and oil and gas demand went down. Production wasn't brought online, and it picked up a lot quicker than I guess people expected. So what we're dealing with right now, when compared to previous years or previous sort of oil and gas bull markets, is a real sort of generational problem, really a real structural problem of 10 years of underinvestment and growing demand. This has obviously been compounded to some degree by the war in Ukraine and Russia. But for those people who are concerned about that, the price has gone up purely because of that. The oil and gas prices are already elevated and trading $100 above before that war commenced. So our view is sort of higher for longer. This is a real supply and demand issue that's not going to be fixed overnight. This is a great time to be in oil and gas. It's a great time, especially if you're a producer, which we are. We saw the lows the last 10 years, and really in this period was when sort of Brookside started acquiring acreage. This is really sort of the standard playbook is pick up acreage when prices are low and start producing into the bull market. So we're in decade high bull markets. I look today, oil is trading around 99, WTI is at $99 US, and gas in the US is around $9 per MBTU. Like I said, considerable underinvestment, longer for higher. I know that there's concerns about recession coming on. How's that going to impact? Fundamentally, we don't see that as a big change to oil and gas pricing. It's the supply is there. Everyone's sort of maxed out with regards to how much they can supply. So even if there's let's say decrease in demand is so much higher than supply at the moment, then any drop in demand would, if anything, go to maybe rebalancing. But definitely we don't see massive downside to oil and gas pricing in the near future. So a bit about Brookside. So we have acreage in Oklahoma. We have what we call them 3 big wells. So these are what we refer to wells that produce over 1,000 barrels equivalent a day. So we plan to have 3 on production by the middle of the year. So basically by the end of this month, we already have 2 on production. Right now, I guess right now it's fair to say that we're producing sort of around 2,000 barrels of oil equivalent per day, which is quite a considerable amount for oil and gas companies, especially of our size or compared to even our peers on the ASX. We were lucky enough to produce into the highest oil and gas markets in a decade. Look, I can tell you that was planned. There's a bit of plan there, but also we got a little lucky. I've been in situations in the past where you can have a great discovery, big resource, and you're producing to a bear market. So we're lucky that our wells, we found ourselves in the sweet spot of timing and pricing. We're able to start drilling high quality acreage into very high oil and gas prices. We can turn these around. We can bring these wells to market essentially within 3 or 4 months of spudding. So we're not doing 5-year long-term developments. We get these wells online on sales within 3 to 4 months of spudding them. and that's something we want to project as we go forward. We have 3 drilling spacing units, as referred to them. So basically, we have 3 independent bits, areas of acreage. And once you draw those up, like I said, 2 already producing, one's about to come online. You hold that acreage forever as long as you're producing. So we had an obligation to draw those up before we lost the acreage. Now we've drilled them, the acreage will be held by us, and that basically allows us to control the levers on timing and deciding where we drill next. We are under no pressure to drill in any particular area, under no pressure to drill anything, quite frankly. But we have plans to drill quite a few wells coming up. We have an inventory of almost 20 wells plus, and we have 3 areas where we can now concentrate on drilling, since we now hold them forever as we produce. So that's a key milestone for us this year, was to achieve that, to get those 3 wells drilled and produced, so we don't lose the acreage. And now we're about to finish it off with our 3rd well. Obviously, once you start drilling the acreage gets reevaluated, so the value of the acreage goes up because it's now a proven producer. People can then plan how many wells they can put in, and I'll give the details in a minute. But these are areas where you can put in multiple wells for different horizons. But these are we have a large inventory of high quality wells. They're high impact, very high rate of returns, 100% plus, and they're low risk. These are essentially development wells in areas of proven production, existing infrastructure. So we're not drilling exploration wildcats. And obviously, once we all the free cash flow coming out of our held by production acreage helps us accelerate future drilling. A bit about Brookside. We're a small entity. There's a handful of us, a couple of us really in Brookside, myself and the MD in Perth, myself and the MD Dave, and we have a subsidiary in Oklahoma, which I'll discuss in a minute. Basically, mean, lean, low capital requirements. Each of our wells is a standalone development that comes on quickly and starts producing and delivering cash flow. We have a small environmental geographic footprint. These are not big developments. We work on private land in the US, where most of the drilling does take place. So clearly, we have to do everything by the book and do it clean and keep a good relationship, maintain a good relationship with landowners. If we do something wrong, if we do it unsafely, if we have bad environmental practices, then we won't get any more acreage. The landowner will throw you off, or you'll talk to his mate next door and you won't pick up any acreage ever again. So by default, we work hand in hand with the local landowners, with the local communities. If we don't, we wouldn't last very long in that area, in that business in the US. The other thing is we have quick return on invested capital. Our first well paid out in under 6 months. Our second well, the Rangers well, is estimated to pay out in around 7 months. So this is phenomenal, quick return of capital of the company, which we can quickly reinvest into future wells. And then one thing I'll say about in Oklahoma, we are on the ground in Oklahoma, where there is, unlike working, let's say, in Australia, a lot of infrastructure, a lot of oil pipelines, gas pipelines. So it's very easy to get your product to market. You get to market very quickly as soon as it comes online. So as I said, we work with communities to ensure sustainable growth and value creation through the safe and efficient development of energy assets. On the right is an image in Tatum's, Oklahoma, which is one of the counties one of the towns in the county we work in over there, where we work with the local municipality. We donated some money so they could fix some roofs on municipal buildings. We provided a sewage pump for the sewage system. So we work hand in hand with the local community and give back, and which we see it's sort of really one of the pillars of our businesses. Now, the 3, I suppose, main pillars of our businesses are operator drilling, PDP acquisitions, and land leasing. And operator drilling is what we are discussing primarily today, where we operate and drill our own wells. Proven development, producing acquisition, so we go out and acquire land that maybe has some producing wells on it, or maybe in terminal decline, but still throw a bit of oil and gas out. And land leasing is, well, we're in a land and leasing business. We're an oil and gas company by default. The land is the bread and butter. We need the land to drill, and we need the land to prove up. And ultimately, when if the price is right, we sell the land to someone else, to a bigger player who can maybe monetize it more efficiently than us, but we prove out the value and get that initial big jump. So we have, sorry if I'm going through this a bit quick, I'm cognizant of the time limit. So we have two formations we work with, two formations in our area of interest. We have the Sycamore formation, which is limestone formation. It's around 300 feet or over 100, so 100 meters, give or take, thick. And that lies right on top of the Woodford formation. So these are big formations, the Woodford, the Shell formation. These are big formations that run through the area of the Anadarko Basin where we are located in Oklahoma. They are, historical producers. There's been a lot of historical drilling in the area from, historical vertical wells. These are big rocks, and if you drill them properly and complete them properly, they are great producers. 1,800 barrels per day or equivalent, plus, over 1,000 plus. Astronomical rates of return. In these commodity markets, obviously very quick payouts, and they have a very low break-even price. So one of the questions people ask, how do you protect yourself, or where do you think your oil and gas price is going? Look, I spent 20 years of my life working for the majors around the world, including being Houston, working for a US major, and predicting oil and gas is a very hard game. We weren't very good at it. So the best way to protect yourself against oil and gas pricing downturn is to make sure you have a low break-even price. So our break-even price is around between $20 and $30. So there's a long way for the oil and gas price to fall before we are actually losing money. So that's what helps us sleep at night. So the takeaway there is big formations, great rocks, big producers, big quick payouts, and a lot of historical data showing that identifying the sweet spots. So, and I would tell you right now, and for those that are listening, I'd say right now, because we have a mix of commodity, we have oil and gas in our formations, plus we have natural gas liquids. We have very rich gas. I guess we're getting around, what have I got here? Just looking at my notes. We're getting close to sort of $80 a barrel gross on the mix. That's 80 US, so almost 110 plus Aussie. So we're getting quite a lot of money for our barrels over there. We're unhedged, so we have full exposure to the upside, and people say, well, to the downside as well. But yeah, right now it's higher for longer is what we're seeing. So we are not limited. We're not capped on gas pricing. We are fully exposed to the upside, which is great for us, and that's been beneficial, and as indicated by what we're producing in our quarterly results. Now, just for the folks who hoped I'd be sort of front running the quarterly today, I won't be. The quarterly will be out tomorrow after close of market, and we will be hosting a webinar, so I suppose an earnings call next Thursday at 9:30 a.m. We'll put that announcement out and the link out shortly. So apologies to those folks. It's a bit difficult to have a presentation today, knowing the quarterly is out tomorrow. So, but please bear with me. So we have a capital structure with about 80 million market cap, 5 billion shares on issue. We just recently converted a bunch of options, which maybe been overhang in the share price. So we have no options essentially outstanding. That's all been taken care of. At the end of the last quarter, we had around just shy of 20 million Aussie in the bank, 3,400 acres, and a prospective resource of around 12 million barrels equivalent. Share price, ironically, has gone inverse to the operations success. So it's been sort of on a bit of a downtrend for the last 7-8 months, which is, I'm sure, a stress for everyone, including myself. I'm a considerable holder of Brookside shares, a lot of them which I pay for in my own pocket. So, we are doing everything we can operationally, and we have confidence in the market that eventually, especially once you folks see the quarterly tomorrow, you will see. We are very confident that will be reflected in the share price. So we're hitting the runs on the ground. We're producing. The company's making a lot of money. The share price, we believe, will respond accordingly. There are other things we have, other things we're looking at. I'm not privy. Won't be able to discuss at the moment, but we're all in the same boat. We're all shareholders, and we are, in my opinion, personally, we're extremely undervalued right now, based on what we have, based on what's in the ground, based on what we're producing. But ultimately the market decides where the value is. So a bit of the structure. So there's Brookside Energy. This is Perth office. On the left is the MD Dave Prentice, who sends his apologies for not being here today. Mickey Fry is the chairman, Richard Humphrey, non-exec director, myself, the executive GM commercial. I'm a geophysicist with 25 years plus experience. I also have extensive commercial experience. And like I said, I came back to Perth about 4 years ago, joined Brookside about 2 years ago. Prior to that, I was with Exxon for 10 years and prior to Aberdeen with Total and so on and so forth. So I have extensive oil and gas experience. And Black Mesa, and look, this is our team on the ground. And let's be honest, if you don't have a team on the ground, you're destined to fail. So we have guys on the ground, local guys on the ground who are part of the Black Mesa, who basically control the Black Mesa, in charge of the Black Mesa subsidiary. They are local guys, they have equity, so they are attuned to success. They have skin in the game. And there's our landman, Chris Gerard, and his president, John Schumer, resident engineer, and Lee Francis is our ops guy, all highly experienced, all local. And you need the local talent, you need the local guys on the ground, because you are dealing with the local landowners, the local municipalities, the local contractors. So they have very great and extensive network, and we pull people in as we need them. We use consultants as required for different stages of our operation. So, without that team on the ground, it'll be a whole different conversation right now. So quickly, we're in Adenaka, we're in Oklahoma. So that's sort of state above Texas. We're in the Adenaka Basin, which is a massive, huge basin. And we are located down here really in the swish. We have some non-operated stuff up here in the stack, but we have our sort of swish area of interest, as we call it, down the scoop part of the acreage of the basin. That's where we're focusing right now, so in the Carter, Stevens counties. So this is one of the big basins in the US, has produced billion plus barrels over the years, both conventional, unconventional. And this is an area that was identified by Brookside several, 5+ years ago. And they sort of start off in the stack as a non-operator, farming into wells. And the big guys were drilling, and they sort of learnt from what they were doing, and then they took that skill set and applied it somewhere else and identified this area which we refer to the swish area of interest. So to get an idea, Brookside was really the first company to identify this area. Subsequent to that, a lot of the big guys have followed us down. There's 30, 40+ wells drilled. Initially, they were all sort of historical vertical wells. A lot of them are now horizontals. The new modern horizontals have come in. A lot of the big guys are in there. Continental Resources. You see the table on the right, which outlines some of the best wells out there. We're quite happy that we're in that list. What you see in that table on the right was a lot of Continental Resources, which is 20 billion plus oil and gas company in the US. 12 months ago, there was a mix of different companies, but Continental has been slowly scooping everyone up. So we have 3 DSUs, as you can see in the left image. We have the Ranger DSU, the Flames, and the Jewell DSUs. The Jewell was the first well that we drilled that, like I said, came on gangbuster. And look, for us, anything over 1,000 barrels equivalent a day is a phenomenal result. Both of our wells have done considerably above that. So the Jewell is our first well, the Rangers in the sort of center left was our second well, and the Flames are just flowing back right now, which should be on production sales in the next couple of days, is up in the north. We have other bits of acreage that we don't hold as a drilling spacing unit, but we have interest in those units, and so we have equity in other sort of non-operated wells, and there's some royalty interest in other bits and pieces. But that gives you sort of lay of the land that we're in a great sweet spot that we identified. Unfortunately, didn't have the capital at the time to pick everything up. If we did, we'd be a whole different company right now. But we reserve the best for ourselves as we horse traded to the best acreage, and we're still actively looking for acreage in the area and outside of the area. So we're not just sort of sitting around doing nothing and just focusing on drilling or going off the pub. We're actively growing our acreage position. So this is just a refresher for those folks that haven't seen it from their last quarterly results. So we had revenue of just shy of 8 million Australian dollars, cash positive from operations for the quarter, with operating profit around 2.3 million. We had just under 20 million Aussie cash on hand, unhedged with no debt. and our gross operated daily production of around 1,000 barrels per day. I can tell you that has really, doubled now. We're close to 2,000 gross barrels a day. So it's a, tremendous growth story in such a short time, considering that, 12 months ago, we were probably at 100 barrels net. It's, onwards and upwards. So this was, just a refresher for those folks who haven't seen that our first well, the Brookside, the Jewell well. We drilled that with another party, so that was our first well. So we wanted to sort of just even though we thought the risk was low, we thought we'd get someone to just help us with that first well, also help us with capital. So we took on 50% of the acreage, 52% of the interest in that well. We own around 80% of the interest in the actual drill spacing unit. So just that well alone, we're in 52%. Only just 52%. It's been a great producer. It's produced almost to mid-May. I don't want to, like I said, don't want to front run the quarterly, but that's produced over 300,000 barrels equivalent by mid-May, 131,000 barrels of oil. So paid out less than 6 months. It's, in excess of 11, 12 million bucks produced. Phenomenal well, a real game changer for us, going strongly. So that was the first well, and that really was like I said, that came in above expectations. It was a phenomenal well, and that allowed us to lock up our first drill spacing unit, put on production, and then so that dual drilling spacing unit is now held by us 80%. Our second big well, we done the Ranges, in the Ranges drill spacing unit. So the Ranges well, we had an announcement about this morning. So this one only came on production in April 2022. The Jewell came on sort of last year, towards the end of last year, or late last year. The Ranges came on in April, so it's still very early in the well's life. And these wells often run for 25 to 30 years. So these are long-term wells. They come up quite strongly, then they'll decline initially, and then sort of stabilize with a long tail. So this well, the Ranges came on in April 22, so just a few months ago. It's already achieved around 1,200 barrels equivalent per day on the sort of IP30 stable monthly production rate. It had a peak oil rate of just under 1,000, a gas rate of 2 million per day, and on top of that, another 270 barrels of natural gas liquid. So, like I said, anything over 1,000 barrels is a massive well, and so this is another great well for us. We have 80% in this well, and 80% in the area around it, the drill spacing unit. It's already produced around 82,000 barrels of oil, and this well down this part, even though it's drilling the Sycamore formation, just like the Jewell well, it's actually it's an oilier formation. So this one has a higher liquids count. Estimated payout for this one late this quarter, so let's say around 7 months. The first well was just under 6. Like I said, and there's, when we first started playing these wells, we thought we'd be lucky if we could get these things paid out in 14 months, which we thought 14 months was great. Anything under 2 years is great. The fact that we're getting our money back, within 6, 7 months is phenomenal. And there's always going to be variability between wells. The different wells and different parts of the geology changes, quite quickly in a short distance. But this well was a little more expensive than the Jewell. So the Jewell was around $9 million US. These, like I said, they're the big wells. They come on big, but they cost a bit of money. And the range as well was around probably around 10 million, give or take, US. So there's a bit of pricing inflation there. So slightly slower payout, producing slightly less than phenomenal production, slightly less than Jewell, but just a great result. But slightly more expensive well, but that's offset by being slightly oilier. So it's a bit of a balancing act there, because it might cost more, but it's producing more liquid, so you're getting more money for your barrel. So it'll pay out shortly. Like I said, when we get that money, from day one producer, we can start getting that money back, so we can concentrate on the next one. So if nothing else, if we were to do nothing else, we could right now sit there and every 7 months drill one of these wells. And if not, we plan to do a lot more than that. But just to give you the sort of scale that we can drill a $10 million well, $10, $11 million well every 7 months, based just on the cash flow from the existing from one well, let alone from 2 wells. So another great result. Locked up that second bit of acreage there, and now we can put a whole bunch of other wells in there. And this is just in the Sycamore. So we've been touched the Woodford formation there. Woodford formation's pristine. And then we went to the Flames. And the Flames, we decided to drill the Woodford instead of the Sycamore. Now, the Flames was our biggest, I suppose, our deepest and our longest well. It's around 17,000 feet, sort of all in, distance-wise, with a 10,000-foot lateral. So these are all horizontal wells. The Jewell and the range is a little shorter, around 7,500 feet. This one was at 10,000 feet. So this is a full-length lateral. It's a massive well. You don't, the scale is, you don't appreciate the scale. You got a well that goes 3,000, a couple of kilometers down, and 3,000 kilometers, 3 kilometers across. So it's a longer well. Obviously a little more expensive. It's a little deeper and is longer, probably more to sort of over 11 million US cost. Also, like I said, a bit of oil field inflation. It's flowing back. Last announcement we said it's flowing back. The oil and gas already recovered, and it will be on production and sales in the next couple of days. So we expect great things from this well. We expect another great well that'll come in over 1,000 barrels. And there's some offsetting wells that were drilled in a similar formation that got to 1,600 barrels equivalent per day. So will we get there? I don't know, but I'm fairly confident we'll get over 1,000. And then we'll see. So no, another great well. Can't wait to see it on and start producing it and adding, adding more cash flow to the company. So that's 3 wells drilled in 3 DSUs. The first 2 are locked up and producing, so they're called, they're held by production. The first 2 were drilled in the Sycamore formation. And the next one, the Flames DSU, that should be locked up in the next couple of days once we go on to sales. So that'll be our HBP program completed. So then we can focus on developing these further. So you can, like I said, you can do multiple wells for each of these formations. You have the formation beneath it, so you can average 3, 6 plus wells on one of these sort of DSUs depending on how they produce. Obviously, you want to take time to actually put the first well in, give it a few months to run to then get the information to understand how the well's producing. Because what you don't want to do is put these wells too close together and kill one well while putting the second one in and so forth. So you do want to have a bit of a break between drilling some of these wells just to get some information on how the reservoir actually flows. So 3 wells down, 2 HBP, 1 next couple of days, and then we're off to the next step. So here we are. So this is our first half of the year where we came in basically essentially on time, on budget, and obviously safely. We plan to drill 2 more wells before the end of the year, and then we have a notional plan to drill 4 more wells per year after that. Now we have multiple off ramps. So there's always questions we get about, are you going to drill, are you going to sell? Are you going to drill, are you going to sell? Let's put it this way. We have 2 formations, and in each DSU so far, we've drilled 1 formation. So the other formation would be the Sycamore or the Woodford is left untouched and pristine for potential sales should someone come along and give us the price we're asking for. But in the meantime, we're not going to sit there and do nothing and hope that someone comes knocking down the door or stop any operations. In the meantime, we'll drill up the ones that we've already drilled into to build our operations and to build our production numbers and ultimately to build our cash flow and to create value for the shareholders. So that's the current plan. People got to understand that we're drilling wells. These are big operations. Oil price is running high. Rig counts low. A lot of rigs were stacked during COVID, and the oil and gas industry has been sort of has been suffering from low oil prices for a better part of a decade. So as we ramp up now, there is obviously growing demand for rigs, and all rigs aren't created equal. So I need if I want a vertical rig, that's easy to get. But if I want a big rig to do a 10,000-foot lateral, well, that's a different rig. So it's not a rig's not a rig, not a rig. I need a specific rig for a specific well. Depending on the depth of your well and the ultimate length of your well. That will tell you what kind of rig you need, and unfortunately they're not all parked up at the local Bunnings, but they're all out there drilling actively. So you got to get in the queue and wait for them. And we're actively talking every day to rig companies. We talk every day, obviously, to companies that complete the wells, because we have two stages to a well. There's the drilling, then there's the completion. So, yep, and we're actively chasing that down. And but that's the plan right now. So 2 wells before the year's out, and then on to the next 4. And then like I said, in the meantime, we're ultimately looking at other acreage positions and so on and so forth, and building and growing the company. Last slide, really just the Continental. Like I said, big guys are scooping companies up left, right, and centre. We've had a few sort of people kicking the tires. So watch this space, really. And I think that's it. So it's pretty a bit quick there, but